So is it an AI bubble? 30 minutes until the start of trading. We're going to ask that question a lot today. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Delta and Pepsi post solid results as investors look to earnings for signs that a tech-fueled rally can continue with non-tech companies.
Meanwhile, to the surprise of Matt Miller, Ferrari shares sank the most since 2016 as a luxury car maker issues a cautious outlook and scales back its EV plans.
Plus, hedge fund titan and distressed debt investor Bruce Richards joins us. He'll weigh in on the possibility of an AI bubble as the debate rages on Wall Street.
It's the two worlds, right? Ferrari apparently is having a harder time selling cars, but we're all buying everything AI, and stocks are at a record high.
Yeah, absolutely. Apparently, we're buying plane tickets.
Yes.
We're buying Pepsis, or
Correct.
at least Poppy sodas.
Yeah, I like Poppies. I'll
and
buy Poppies
so
now.
we see the shares reacting today.
Let me show you what the airlines are doing, because Delta's up 8.7%. Surging. It topped third quarter estimates. It adjusted its full year's earnings to the top end of its range. And at the same time, CEO Ed Bastian says that Delta flyers, Matt, are in a good financial position entering into next year.
Also on the Pepsi story, it reported its strongest growth for its beverage unit in 2 years. The company, of course, under pressure because Elliott Management took a $4 billion stake last month, and it is trimming the amount of products it offers in terms of the snack side of the business. The shares today up 1.6% in the pre-market.
Let's get into those Delta earnings first, Matt, because we have on the desk is Bloomberg Chief Aviation Correspondent Sid Phillip. Sid, it was a tough start to the year for aviation, but it feels like it's come back in full force, especially with people that are willing to pay up for business and first class.
Absolutely. I mean, for the airline industry, there is this dichotomy where at the top end of the market, people are willing to travel and travel like never before. And at the bottom end of the market, the ultra low-cost carriers are the ones struggling. Like we've seen Spirit Airlines go into the second bankruptcy. And so there is this dichotomy in the industry, and especially for airlines like Delta Airlines and United, which are premium focused and they're focused on getting that top end of the market, that sector seems to be booming.
So it's not just the first class passengers, though. It's not just business, right? Because Ed Bastian said the main cabin is full as well.
So Ed Bastian saying that the main cabin is recovering, and that's sort of a change from the position where they were earlier, where the main cabin was lagging both business and corporate travel. So essentially that's a sort of sign that there is some sort of ways to go in terms of the recovery, but at the same time, it is recovering as opposed to having sort of slow performance in the main cabin.
What about corporate travel? Because this was supposed to be a moment where corporates were uncertain. People didn't know what the business environment was. But again, to your point, Ed Bastian saying that that was one of the strong points.
Yeah, so Delta's seen a growth in business travel, and they said that 90% of the companies they polled in said that they will see more travel next year. So, I mean, there does seem to be signs that companies are getting used to the normal and essentially getting back to flying again.
All right, Sid, thanks so much for joining us. Bloomberg Chief Aviation Correspondent Sid Phillip here with us at the desk. Let's get to Pepsi's earnings report now. The snack and beverage giant posting stronger than expected net revenue growth coming from its trademark Pepsi soda, as well as the new Poppy sodas, which are like probiotic or something. Here with more is Bloomberg's managing editor for global business, Shelley Banjo. I was thinking the Poppy growth, that can't be such a huge story, right? How many Poppies do they sell compared to Pepsi's?
I mean, Poppy is growing. No sugars, Pepsi is doing okay. But here's the sort of fine print here. Volume is not growing. It's revenue growth that is growing. So people are buying, that is not necessarily they're buying more units. They're just spending more on these things. So it is a bright spot for Pepsi. It's not declining, so that's good for them. But it's not like people are rushing out and just stocking up on more soda.
Yeah, I buy like a case of Poppy a week, so I'm
Seriously?
I'm 100% serious.
She's fueling the Poppy habit.
I'm otherwise not a soda person, but okay, so that's doing well. But to your point, the CEO was speaking just moments ago, saying that consumers are stressed all over the world. The Hispanic cohort in the U.S. is being impacted. If this is the case, if there is real stress, shouldn't brand names like Pepsi be doing worse because people are trading down to white label products or what have you?
Yeah, I think this is an expectations game at this moment. I mean, Pepsi has an activist investor inside of it. They are taking a look at their portfolio. They have to figure out how to whittle down some of these things that aren't selling. And I think he's trying to tell people, don't get too excited here. The economy is still not great, especially at the lower end of the spectrum, especially a lot of their customers who are, big soda drinkers.
All right, Shelley, thank you so much for that. That is Bloomberg's Shelley Banjo. Now, elsewhere in tech news, the U.S. has approved Nvidia chip exports to the UAE under a bilateral AI agreement. That approval was made after UAE had concrete plans for a $1.4 trillion investment in the U.S. over the next decade. Bloomberg Intelligence Global Head of Tech Research Mandeep Singh is at the desk. And Mandeep, it was something that we were waiting for after this agreement was first talked about in May. How big of a win is this for Nvidia?
I mean, we know the size of the opportunity. It's up to 5 gigawatts. The question when it comes to sovereign entities is, yes, they will procure the chips. It would take probably about 2.5 to 3 million GPU chips to build, 5 gigawatt capacity. What are they going to do with it without an LLM? And so if you don't have an Openai or Anthropic or one of these LLM providers involved as part of consuming the chips, what exactly is, the Middle East or the entity doing with all the compute capacity? Maybe they have a master plan, but that's the part that I don't know. And I think it'll be interesting to see how they consume the chips.
Well, there will be chips. It looks like Taiwan Semiconductor Manufacturing reported a 30% increase in its third quarter sales. So at least we know they're building them.
Absolutely. And look, when it comes to TSMC, just with these two deals that were announced with OpenAI, one with Nvidia and with AMD, I mean, think about the scale of it. We're talking about 6 to 7 million chips that are going to TSMC.
That's what, 16 gigawatts between those two deals, right?
And that's almost 6 to 7 million GPUs we are talking about. And so TSMC has a lot of business. Even with the Nvidia Intel investment, they didn't talk about using the foundry. So we know until and unless there's a viable alternative to TSMC manufacturing, everybody who is talking about AI accelerators or some sort of building AI chips, they have to go to TSMC.
TSMC, though, used to be closely linked to what the smartphone cycle was doing. Is that just over for them, that they will do well regardless because of this demand for chips?
So that's where the diversification comes in. I mean, right now, all that 30% growth is powered by AI accelerators. Imagine when we have a powerful refresh cycle on the smartphone and PC side, you could even see 50% growth if everything lines up well. So clearly, their business is very well diversified, and they don't have any competition. I mean, this is still a monopoly.
Mandeep, how do you see the bubble debate right now? Because you mentioned those two deals with OpenAI, right? Nvidia paying OpenAI $100 billion to buy its chip. AMD says, no, we'll give you 10% of our company to buy our chips. Yeah. Is that problematic? Is that frothy? Is that a red flag?
I mean, clearly the optics are bad. Anybody who's looking at it is like, why is Nvidia involved when they are the supplier? So I agree with you. At the same time, the numbers have gotten so big that to, just look at the demand side. Tokens have grown 50x. How do you satisfy the demand when something is growing 50x? And at scale that AI data centers are, you need funding. I mean, and Nvidia has the balance sheet. So that's
But does it continue to grow at that pace? My experience, which is purely anecdotal, and this is editorial, but is that these large language models haven't gotten any better and really aren't that good once you finish being surprised by the fact that they mimic,
Then why has the token consumption grown 50x for even Google? OpenAI token consumption has grown 50x. I mean, imagine if something doubles or triples, we get excited. 50x, even if it's an exaggeration. And
because it's from zero, right? I mean, what's Bitcoin up from 2009?
Well, so if anything is up 50x, and we know the power isn't growing even 2x, so how do you, satisfy all the demand that's coming from users? And the use cases are growing. They're not very well established. It's not end-to-end in terms of an agentic use case, but clearly people are consuming this. And that's where tokens is the best way to measure the demand side. And 50x of anything it's like the demand is off the charts.
You see that in the public markets of investors trying to figure out just how much these things are worth. I think AMD this week is a really good example of it. It's been up every single day since it announced that deal. And it's up 43%, I think, so far this week. You could look at that and say, okay, our puny little human minds have a hard time wrapping around the opportunity here. Or you could say, we're just getting overly excited and we're bidding these things up too far without actually knowing what the future holds.
I mean, look, because the numbers are so big, there's no way you can build out, $500 billion worth of infrastructure without getting the financing from either the private markets or sovereigns or some entity. That's why it's good that we have companies with, large balance sheets. I'm pretty optimistic that all the hyperscalers are going to raise their capex this quarter. It's a given because OpenAI has raised the stakes so much, and they are saying our revenue is a function of power and chip availability. And if they're adding, 7 to 8 million more GPUs and 16 gigawatt of power, their revenue will grow much faster than all the other hyperscalers if they don't accelerate at the same way. So they're forcing everyone to do the same here.
All right, Mandeep, it's been great having you here. I will point out that later in this program, we're going to talk to a guy who's building a private electric grid to support an 11 gigawatt, 5,000 acre AI data center campus in Texas. So we'll talk to the CEO of Fermi America. Mandeep Singh there from Bloomberg Intelligence. Let's get a quick check on futures right now. Nvidia is gaining in the pre-market. That should tell you something. We see a green arrow on S&P futures after a record close yesterday. Was it the 33rd record close? I think it was the 33rd.
It was definitely yes, it was the 33rd and 31st for the NASDAQ 100.
So we do see the NASDAQ giving up a little bit of ground today, but it's emphasis on little, right? There's just not a lot of movement in the broader
I feel like this is
today.
kind of typical. It's like a flat or a down market to starter and pre-market, and by the end of the trading day, at least into the close, there is a bidding up. It's like the Pavlovian urge that we keep hitting new records that you might as well jump in and buy.
That's what a melt-up is, right?
Correct. Yeah. That is what a melt-up is.
All right, coming up, we're going to give you more on Delta's bullish outlook with TD Cowen analyst Tom Fitzgerald. And as I said, we had the CEO of Fermi America coming on. They IPO'd on Tuesday, and they're up $5 since the initial trade. This is Bloomberg Open Interest. Let's get now to high interest to look at what's making headlines around the world. Israel and Hamas have agreed to a ceasefire and the release of all hostages in Gaza. This marks the first major step toward ending the 2-year war. The U.S. brokered deal was reached overnight in Egypt with help from Qatar and Turkey. The Israeli Security Cabinet and the full cabinet will meet next hour to formally approve the agreement. Israel's Deputy Minister of Foreign Affairs told Bloomberg Television earlier that Prime Minister Benjamin Netanyahu has the backing of the cabinet for the Trump deal and hopes hostages could be released this weekend.
If this deal will be signed, we expect them, at least the 20 live hostages, to be back already on the weekend in the loving arms of their family. And that would be incredible news. As President Trump put through his plan, it's meant to go through 72 hours for the release of the entire hostages. We hope that will still be the deal, but as I said, the small details and the changes will be addressed and talked in the next couple of hours.
Now, here in the U.S., the government shutdown is hitting taxpayers and travelers hard. The IRS will furlough 34,000 workers, pausing most services as a October 15th tax deadline looms. In the skies, air traffic control shortages are delaying flights from Dallas to D.C., while the TSA warns of longer lines. With federal pay frozen, pressure is mounting on Washington to strike a deal. House Minority Leader Hakeem Jeffries joined Bloomberg Television earlier to talk about the stalemate with the GOP.
They've refused to negotiate at every step of the way throughout this year. They've taken a my way or the highway approach. They've gone it alone. And now we find ourselves dealing with this mess of this Republican healthcare crisis, and time has run out.
Some good news for New Yorkers. Manhattan rents slipped in September as the summer frenzy cooled. The median monthly rent hit $4,550 a month. That's $150 below July's record, but still 8% higher than last year. fewer new leases suggests that more renters are renewing rather than competing in a pricey and uncertain market.
Meanwhile, on to earnings. Delta Airlines earlier this morning reported better than expected earnings for the third quarter, helped by leisure travelers and a rebound in corporate travelers. TD Cowen Airlines analyst Tom Fitzgerald has a buy rating on the stock and joins us now. Tom, it's incredible to look at the haves and have-nots for the airline industry. As Spirit goes bankrupt, Delta puts out a banner of a quarter. Just how strong were the results?
They were very strong. They beat consensus expectations despite having sold a lot of inventory back around Liberation Day earlier in the spring when demand was much more uncertain. 4Q results exceeded expectations, and they met where investors that we speak with were looking for. And I think they painted a really constructive and optimistic outlook for 2026. And we believe that, yes, to your point, the haves and have-nots, this airline divergence is just set to continue.
How does this dovetail with a weaker consumer, a government shutdown, a job market that is spurring the Fed to cut rates? I mean, what's going on at Delta with its customers that's different than the rest of America?
Well, Delta's customer base skews more affluent than I would say that the typical airline or maybe the average, the median consumer in the United States. And I think with the stock market rebounding very strongly since the second quarter, that buoys higher income spending, and due to the wealth effect, we've seen a lot of corporate traffic getting back on the road, tech and banking in particular, but that strength seems to be broadening out. Delta's got a lot of exposure there. There's been an interesting dynamic on the elongation of the Atlantic summer travel season. A lot of baby boomers who are a little more flexible with when and where they travel. They prefer to go in October when it's less hot, less crowded. So that raises the floor on 4Q revenue performance. That's something other airlines, a domestic focused leisure carrier is not going to have exposure to. So I think the main takeaway for investors is that the breadth of Delta's revenue streams are really just, they're firing on all cylinders, and they it builds so much more resilience into them than just an average airline relying on main cabin.
Tom, what happens if we do get a shutdown that continues to stretch into week 3, week 4, if TSA starts to get more impact, if air traffic control starts to get further impacted? What will be the repercussions for this industry?
It's certainly a risk that we're monitoring. I'm encouraged that policymakers on both sides of the aisle understand how critically important air travel is to the broader economy. I also think it's important to note that the industry itself has gotten much more adept at navigating these shutdowns. They didn't used to be that commonplace, but they're much more frequent occurrences over the last 12 or so years, and they've gotten more used to it. If you look at there's obviously a lot of concerning headlines, but we've mainly seen delays tick up a little bit. We haven't seen cancellations en masse or any major disruptions that are curtailing broader economic spending.
So the two biggest costs for an airline are always labor and fuel. I can never remember which is first and second, but those are the majors. Do those look good into the future? I mean, oil prices are low, and there doesn't seem to be a lot of competition in the market for jobs. Is that the case?
Yeah, I think, to your point, oil prices are low, which is always favorable for the industry. Delta's done a great job at managing their cost, and a lot of undulations going on this year, and different rates of capacity growth in different quarters. But they've executed on their goal of targeting low single-digit non-fuel unit cost growth this year. So we've been really encouraged at how they've been able to manage through that and execute on their non-fuel cost control. I think part of that is they continue to lead the industry in really strong operations, and one of the best ways to keep your cost in line is to run an on-time airline.
Hey, what about capacity? Are they able to get new planes? Recently flew to Seattle and noticed even in business class for $5,000, I couldn't lie down as the plane felt like it was 2 decades old.
Yeah, I mean, that's going to be, I would say if you're looking for a lie flat, those are more often going to be in LA or San Francisco on the transcon market. But I think that the diversity in Delta's fleet has been an advantage. Similar with United, having some of those older aircraft, it gives you much more flexibility and optionality and when and where you fly, because the fixed costs are so much lower on an aircraft that's fully depreciated, that's maybe 15 or more years old. And they're not, they can go into maybe a riskier market that if you were buying a brand new airline, or aircraft you would probably have a higher profit hurdle on. But the capacity outlook is very favorable. Just to circle back on that question, the industry laggards, the low cost, the leisure focused airlines continue to retrench. Delta's been pulling back on their main cabin seat supply, so they should have a nice mixed tailwind. I think supply is kind of going to be growing in line or below nominal GDP. Or real GDP below nominal GDP, and I think it's a favorable outlook. The tier one airlines like a Delta or United, they're always going to be. Airbus and Boeing want to keep those customers happy.
All right, Tom, thank you so much for joining us this morning. TD Cowen's
Thanks
Tom Fitzgerald. And Matt, as we've been talking about the government shutdown disruption, Sean Duffy, the U.S. Transportation Secretary, speaking on Fox News right now, saying that they will not be paying air traffic controllers who are calling on sick. I can't have people not showing up for work, but to reiterate that it's safe to travel during the government shutdown. But this is what we've seen. If you're not getting paid, why would you go into work? So people are calling out sick.
Who wants to be an air traffic controller, right? You don't get paid very much. The job is incredibly stressful.
Right.
And you don't even get sick days.
Well, remember all those
I can't
stories
imagine that people are going to line up to do that job.
No. Well, don't you remember of all these stories of near collisions and the air traffic controllers literally having PTSD because of looking at calamities in front of them? So they were retiring. They were calling out sick. They were doing whatever they can. And at the moment, the problem is people are calling out sick because they're not getting paid because of a government shutdown, so they don't want to be there.
All right, fascinating story and fascinating comments by the Secretary of Transportation. Coming up, Nuveen Chief Investment Officer Saira Malik discusses the next market catalyst and why she sees huge upside for one Mag 7 stock. We'll tell you what it is after this break. This is Bloomberg Open Interest.
Under 4 minutes until the start of cash equity trading, and the melt-up of yesterday turns into a freeze today, going a whole lot of nowhere. Little change on both the S&P and NASDAQ as Russell 2000 futures fall. Contrast that with gold at a record high, silver at a record high. All of that moving, and again, opening bell coming in just a few minutes' time. Along with Saira Malik of Nuveen, this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We are looking at futures that are doing not much at all, although, any gains today will give us another new record high on the S&P 500, currently at 33 for the year. The New York Stock Exchange opening bell being rung by Alliance Laundry Systems. There's a good, dependable company that does something you can understand, not services or solutions. They do your wash, which is great. They IPO, I think, today. Down at the NASDAQ, a company that does something you probably don't understand. It's a Solana treasury company. So you buy shares in this company, and they take that money plus the money they borrowed, and they buy Solana, which is a cryptocurrency that's not Bitcoin. So,
their ticker is also Ford, which is very confusing. F-O-R-D.
That is a little weird. By the way, did you see Luxembourg was the first country in Europe to buy Bitcoin through an ETF? Matt Siegel from Van Eck writes that they actually have purchased Bitcoin for 1% of their budget.
Well, I guess Luxembourg has a lot of money and not a lot of people, so what else should you do with it besides buy Bitcoin?
But they didn't buy Solana. I just want to point that out.
Very, very important point. Speaking of rich people, by the way, Delta shares doing really well this morning, up 7, almost 8%. Oh, now it's 8% as I speak. Because of the premium offering, they had earnings. They topped third quarter estimates. They adjusted their full year outlook to the top end of its previous range. The CEO, Ed Bastian, says that Delta flyers are in a good financial position entering into 2026. And Matt, of course, the flyers of Delta tend to be wealthier than all the other airlines and pay for business.
Yeah, and that's paying off for them.
For
Pepsi
sure.
reported its strongest growth for its beverage unit in 2 years. That company faces pressure from Elliott Management, especially on the snack side, which took a $4 billion stake last month. But I'm not sure if Pepsi has the most affluent customers. It's doing well because of this Poppy brand that it bought.
And I was going to say, do everyday Americans buy Poppy? But I did see the other day a little girl get super excited because her mom bought her a Poppy soda.
Well, they are far more expensive, right?
Yeah. They're definitely more expensive, and they've got labeling that makes it seem like a little bit more
so
high quality.
Healthy. Must be so healthy, that Poppy.
It doesn't have sugar. It has Lord knows what else in it.
Better than water. Let's stick with earnings here, expectations. Nuveen, Chief Investment Officer Saira Malik says that while analysts haven't significantly lowered estimates, companies are likely to beat earnings per share in aggregate driven by tech. And I think we're looking for, Saira, about, I don't know, 7-8% in the third quarter. We've had double-digit earnings growth in the previous couple of quarters. Do you think we're going to get that high?
I think that we likely will end this quarter with beating earnings seasons again. What is interesting is normally when you go into an earnings season, analysts lower estimates going in, they lower the bar, and then companies beat earnings. We're not seeing that. Actually, analysts have been raising estimates coming into third quarter earnings season. But with expectations at about 8% for year-over-year growth, I think that companies can beat earnings again and probably print in the low double digits. The leader is going to be tech stocks.
Can we just sit on the consumer for a moment, Saira? Because there is this confusion, and hey, Matt, how's it going? There you go. Hey, Saira. There is this confusion at the moment of, okay, Pepsi comes out with pretty good earnings. And again, this was supposed to be a company that maybe was affected by a mass market consumer who didn't want to trade well. Maybe what makes more sense is a delta with the premium consumer doing well. But then you get Ferrari coming out with an outlook that's disappointing. And again, that should be a segment of the population that's doing really well. Do we have any handle on the consumer and consumer-related equities right now?
Well, the consumer their strength has been a surprise this year. What markets expected was that tariffs would come into place and the consumer would weaken. What we have seen, notwithstanding Ferrari, is that the high-end consumer has stayed strong while the lower-end consumer has struggled. So that's the issue there. And what happens from here, we're still not seeing an impact from tariffs in terms of spending and consumer sentiment, but holiday season is still to come there. Our theory is that a lot of companies pre-bought inventory because they knew tariffs were coming. So that inventory is just beginning to be at the tail end of running through it. So there could still be some impact on goods and tariffs in terms of the consumer's pocketbook, but it might not happen until holiday season or early 2026.
I think, and we're going to talk to Craig Trudell, our global auto czar, about this in a second, that Ferrari's problem may be of its own making because their hypercar only has a V6 and their new 12-cylinder looks like, I don't know, a futuristic nightmare of a Daytona. We'll get to that, Saira. I want to talk to you about Google because you're bullish on the stock. It's not underperformed the other Mag 7 stocks other than Nvidia. It's up 226% in total return over the last 5 years. How much further do you think it could go?
Well, three factors that are driving the markets: government shutdown, AI and deals there, and also third quarter earnings season. So let's go to tech. Tech has been the driver of U.S. equities for many years now. That's no different this year. So what we need to think about is, can AI and Mag 7 stocks continue to drive this market higher? And if so, where should we be putting our money? We like Alphabet here. And first of all, there's a free option on Waymo and YouTube, upside there. I think the view that Google's advertising business is going to be at risk because of Openai is overdone. Google Gemini has a lot of upside to it. All of that, I think, is a reason why Google continues to outperform. Now, the other side, of course, for tech stocks is people will look and say, well, they're just too expensive. But if you look at what's been driving tech stocks higher, it's not so much been valuations, it's been earnings driven. Also, in the AI trade versus the late 90s when there was so much supply of internet companies and unprofitable internet companies, this time around, the winners in AI so far are these large mega cap companies like Alphabet, like Microsoft, Nvidia, and Broadcom. And the supply of these companies is low. And that is another plus sign for why technology can continue to do well. And I heard you earlier say that the market has hit something like 33 highs year to date. But when you look at history, Q4 from a seasonal point of view is normally a strong quarter, especially when we're up substantially year to date. So odds are in your favor for this rally to continue.
Hey, Saira, just quickly, because I know you like not just the tech hyperscalers itself, but some of the data centers and electrification play. How are you thinking about investing in that?
Well, for those who are worried about tech valuations, there are derivative plays. We've had, as our Global Investment Committee, infrastructure has been a top pick for us for a couple of years now. We love the tailwinds there. One of them is AI data centers. So there's a company, it's a utility based in Indiana called NiSource. This utility has very strong earnings growth, high quality assets. They are a play on the build out of data centers to support AI and technology, and also the continued electrification of our economy, not only to support artificial intelligence, but also to support the shift to renewable energy. So that's a way to play tech and AI, but do it in a different way from the infrastructure point of view.
All right, Sarah, thank you so much for joining us this morning. That is Nuveen's Saira Malik with stocks failing in some of these sectors to hit new highs. Let's take a check on it right now and what's moving this market. You are higher by 0.06%. Basically the same amount of companies as up as are down this morning. On the upside, you are looking at Nvidia leading after it got an agreement, or Bloomberg reporting suggesting that they will get that approval to sell to the UAE its chips. The bank's also doing well. Costco doing well. It had sales figures yesterday that showed an 8% jump. People spending across the board at Costco and on things like jewelry and little luxuries too. Apple shares, that's what's leading us down this morning alongside Tesla. Another investigation another probe coming from the federal government too. Microsoft, Broadcom. So you do see some of the tech doing poorly. But if you look at the sectors as a whole, most sectors are moving higher this morning. Infotech is down because of the drag of what some of those I just mentioned. Consumer discretionary, the worst performing sector because of home builders. Home builders having a really tough day after Bill Pulte of the Federal Housing Association has put out more tweets on home builders, directing his ire to them at the moment. So those shares sinking. Energy, that is at the top of the pile, Matt.
All right, so it looks like we still have a bias to the upside this morning, and as you say, it could work out that we climb by the day's end when Romain comes on with Katie Greifeld at the close, but not so for Ferrari. Those shares are falling by the most in nearly a decade after issuing a cautious forecast. We'll take a look under the hood next. Make sure there's still an internal combustion engine there. This is Bloomberg Open Interest.
Let's take a look at the top calls this morning. What the analysts are focusing on. First up, Nvidia. The price target was raised to a street high, if you can believe we had another one, of $300 at Cantor Fitzgerald. The analyst there bullish on the chip maker's AI-related growth and says AI is not in a bubble, despite what you've heard from the IMF, the BOE, and kind of everybody else in recent days. They say we are still in the early innings of the investment cycle. Nvidia shares up 1 1/3%. Next up, Draftkings. That gets upgraded to a buy at Berenberg. The analysts say that the recent sell-off has been driven by fears of disruption for predictive markets, and that appears overdone. He also noted that while prediction markets does pose some risk, that there's really been no big impact on DraftKings numbers. Those shares up 2.2%. Finally, Freshpet, that gets a cut at Jefferies. The downgrade comes in the wake of Freshpet's announcement that the CFO is leaving to work in the same role at Campbell's. Yesterday, Bank of America also cut its rating on the company thanks to slowing growth in the pet food category. So there you go, Matt. Those shares down 1%.
Wow, slowing growth in pet food. Things really are turning down.
Yeah, buy your pet's food. What's going on?
Let's turn to a pair of luxury automakers. Ferrari shares are sinking after the automaker issued a cautious forecast and scaled back its EV plans, while Porsche reported weaker sales in China, also sending that stock, which has done horribly since the IPO, into the red again for the session. Joining us now with more is Bloomberg's Global Autos editor, Craig Trudell. And Craig, we have to start with Ferrari. What's going on with race? Because this is a stock that just could not lose.
Yeah, absolutely. I think when you look at how Ferrari has traded relative to its peers, particularly over here in Europe, it's just incredible. I mean, the rise that you've seen since the listing in early 2016, the stock listed a little bit earlier in the U.S., but this is a name that just has been sort of reliably up and up over the years. And I think going into this capital markets day, you saw analysts as bullish as they had been in half a decade. A lot of optimism that surely they were going to have positivity to share. Also sort of early glimpses of the EV that they're bringing to market next year. I think this may have just been a case of the sort of street maybe getting ahead of itself, but also in fairness to the analysts, some real conservatism on the part of the company in terms of where it sees earnings and how quickly it sees earnings growing relative to the last time they had a capital markets day, and those numbers not necessarily being what everybody was hoping for coming into today.
It was supposed to be a coming out party for their EV model, what the Electrica? I don't even know how you pronounce that, but
Electrica,
whatever their car.
yes.
Electrica, thank you. That's actually a very logical name for an electric car. But Greg, the fact that they did have a complete overshadowing of some of its EVs, which, by the way, they have targets. What does it just mean for the future of EVs and the Electrica at Ferrari?
Yeah, I think the more that time goes by, the more that we see, even in some cases like here in Europe, where month to month we have been seeing growth for EV sales. It's just not been at the sort of level that is needed to sort of reach these levels that everybody was expecting for, say 2035, where the EU wanted to phase out combustion cars by then. It's just becoming, clearer by the day that that's not going to happen. And so, how this gets worked out, especially for some of these lower volume manufacturers, they make the case that, look, we're building, in Ferrari's case, 10, 12,000 vehicles a year. Are you really going to sort of subject us to these rules when we're sort of minnows in this much bigger industry? And I do think that it looks likelier by the day that they will sort of be allowed a longer leash for their combustion engines, and they're adjusting their product portfolio plans accordingly.
Well, I mean, you've made a comment that I hear like almost daily on Bloomberg Radio in one of our promos that I think is true for the most part. Once people go electric, they don't tend to go back to ICE because it's a great propulsion method for most people. But I don't know if people really want an electric Ferrari. Having said that, people who've driven the electric Porsche, the Taycan, love it. And Porsche continues to do horribly badly. What's the problem at the German automaker?
I think Porsche and its peers in Germany, the biggest one for a couple of years now has been China. And I think it's a pretty straightforward one in that, they have, attractive product that does well in other parts of the world. And yet the extent to which we've seen an absolute, just sort of brutal price war playing out in that market. And as we've gone, from combustion to electric, the sort of nightmare scenario is that we just see so much of a sort of commodification of performance and a willingness on the part of domestic manufacturers in China to accept, much lower prices for cars than what, these German companies have become accustomed to being able to charge, which is, big fat premiums that are nice for their bottom line. And, so you have that as being a big factor. You also have, U.S. tariffs being a real problem for Porsche. I think the combination of that, along with the malaise that we're seeing in Germany, it's kind of a trifecta of issues for this company that is really difficult for them to sort of shake out of.
Yeah, getting painful. Ferrari shares now down 12.6%. If it closes at this level, it would be the worst since their IPO. Craig, thank you so much. That is Bloomberg's Craig Trudell. Coming up, BlackRock is demanding a payout from Jefferies, which faces tens of millions of losses in the First Brands bankruptcy. We'll discuss how that's shaking out coming up next on Bloomberg Open Interest. Jefferies has come under scrutiny for its relationship with First Brands, which collapsed into bankruptcy amid concerns about its reliance on supply chain financing. One of Jefferies' funds, Point Bonita Capital, has $715 million tied to First Brands debt. Here to join us is Bloomberg finance reporter Catherine Doherty. Catherine, every single day we find out about someone else who's involved with First Brands. A lot of people gave this company financing. How is it starting to all shake out?
So every day we're seeing a new company come forward, and it's very strategic how they're doing this. I think that when we heard from Jefferies just yesterday, they wanted to quell a lot of the rumors that had been going on about their various involvements, whether it be their involvement as the agent on the loan for the company itself, or the various funds that Jefferies is tied to that were funding the company along the way that are now coming forth and estimating what their potential losses could be. So that will be the next storyline to follow. Both which firms will continue to come forth. I don't believe that this is the end of it. I think that this is just the beginning. And then once we start to see through the bankruptcy, what kind of returns investors are going to recover through that whole process, that will be the next stage of this story.
So are we looking at a bad business here, or is fraud potentially one of the causes of this? Because apparently $2.3 billion is just not there, and it's starting to look more like tricolor.
That's also something that is unfolding. Just last night, there was a headline from one of the firms that said essentially, and there was great reporting from Bloomberg that pulled out the details, the actual lawyers that are working for the company saying, hey, where is this $2 billion or so in financing? And the answer was zero. It's gone. So we're going to start to probably see a lot more of that unfold. There's this investigation that is ongoing, so we don't yet know the answers, but there's speculation out there that they were double counting. And so then it becomes a question of if you are a creditor to the company and where you end up in the stack of getting payments either up front or if you're at the end, you might not get anything and your recovery might be zero. So that is still the storyline. And when you have firms coming forth today and saying, this is our exposure, that exposure is just an estimate. So you might see the exposures increase over time, depending on how the bankruptcy and this investigation goes. And then you also might see other firms that are seeing a ripple effect through the credit market.
Right, and a lot of this was backed by assets, and the question is, are the assets
where are they?
There.
Where
Catherine
are they?
Doherty, thanks very much for your coverage. I want to bring in at the desk here hedge fund titan, distressed debt investor, Bruce Richards. He's founder and CEO of Marathon Asset Management, and you're our marquee guest for the 10 o'clock hour, but we thought we'd bring you in just as a teaser at the end of the 9.
Matt, and Catherine, great comments. You asked the question, and so I'll give you the answer. This is your classic distressed scenario. Great company, bad balance sheet. And so Marathon is very involved in First Brands, as you know. We're leading the steering committee of other creditors, working with the company, working with the other creditors, working with Alvarez Marcel, who's the restructuring advisor who's come in to administer this. And they have great brands, is the bottom line. And so you look at Morelli, which is the auto part supplier that filed for bankruptcy earlier this year, where Marathon led that DIP loan and backstopped that with Deutsche Bank.
Also a legendary name in auto parts.
And that's a great name, great company, but over-levered. And so they were forced into restructuring, but they were selling to the OEMs. They were selling to Nissan, Stellantis, Chrysler, as new parts. Where First Brands comes in, they sell to O'Reilly and to AutoZone when you go in and buy in the aftermarket the used parts. And they have the top brands across the industry. And so whether you're buying the filters or the spark plugs or whatever you're buying, chances are it's a First Brand. And so First Brands is a great company with a balance sheet where some irregularities evidently came to light that were off balance sheet that shocked the market. And so Marathon came in and bought in the secondary market. They don't have high yield bonds, it's all bank debt. And so we bought the first lien bank debt, very large size, in the 40s. And we feel good about that position because we think it's a great company that needs to be restructured. And we also came in and led the DIP financing. It's a $1.1 billion DIP facility, and Marathon led that DIP facility to help the company through bankruptcy. So our job at Marathon is to help this great company exit bankruptcy as soon as possible so they can go on with a proper accounting system and do the great things they did do, which is supply all those parts to people around this country and around the world. It's a global firm with global brands.
All right, and this is what you do, whether it's Greek debt or P-Pips or now First Brands. This is what Marathon's business is. Bruce Richards is going to stay with us in the 10 o'clock hour. Also coming up in the next hour, we're going to talk the IPO pipeline with Tommy Rueger of UBS. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. Looking at some red arrows there on the screen, but not huge. And we did have another all-time record high yesterday.
Yeah, the 33rd record high. So what's a decline of less than 0.1%? I'm Dani Berger, and you are watching Bloomberg Open Interest.
Delta and Pepsi post solid results as investors look to earnings for signs that a tech-fueled rally can continue.
Carlyle is stepping into the economic data void left by government shutdowns with a grim read on the labor market. We're going to speak to the man behind the data.
And Fermi is the latest company to get a boost from investors looking for exposure to the AI boom. The company's Wildcatter CEO joins us later this hour. But first, Microsoft's debt may soon look safer than Uncle Sam's. This according to TD Securities. The bank is warning that political gridlock, the government shutdown, tariffs, and big fiscal deficits could push top corporate bonds to yield less than U.S. treasuries. It would mark a stunning flip in market faith. Hedge fund titan and distressed debt investor Bruce Richards, founder and CEO of Marathon Asset Management, is still with us. And I just wanted to ask what you think about this. It's a story that we've covered for months now, the fact that you could eventually think Microsoft's debt is safer than treasuries. What do you make of it?
Well, I mean, there's a lot of treasuries. I think it's a supply-demand thing. I think it's just that simple. They're both super safe. They're both, you call it AAA or, as close to AAA as you can get. And so it's just simply supply and demand. Look at all the governments the U.S. government has to issue versus Microsoft and the pool of money that's available in the IG market list. IG credit is trading at the tightest spread since the 1990s. And so obviously credit is tight. There's a big demand push for credit. And we think, clients overall are underinvested in fixed income and will put a lot of money into fixed income. And where do you start? You can start with a Microsoft.
But does the partisan standstill, does the state of U.S. government spending, which seems to have no end in sight, worry you or not?
The U.S. government spending is no end in sight. You're absolutely right, Matt. And for all of us that are, just focused on what the next generation is going to be and mitigating credit risk and not having this turn into a crisis in decades from now, it's all the right point. Right now, there's no concern whatsoever. Look, the U.S. government is in a very, very strong position. The economy, the magic number is 3.8. 3.8% GDP growth in Q2, 3.8% according to Atlanta Fed. Q3 projection, we'll get that October 30th later this month, provided the government reopens. We can get that data on October 30th. So the economy is actually accelerating. And the good news is going to accelerate further because you have four big levers that are going to be pushed on. Number one is OBBA, which is the bonus depreciation that comes with the July 3rd passage of legislation, allows any company to take that $100 billion, $100 million, whatever the number is, of CapEx and write it off against your taxes day one. The amount of spending that's going to happen in the next couple of years, because when you want to build that factory, buy that equipment, buy those chips, and you can write it off day one, it takes a while to order it, to implement it, to then write it off that year. And so there's a big spend coming that way. Tariffs, while there's a lot of friction and a lot of negativity that's been written about it and maybe the push through for inflation, as it relates to tariffs, the good news is it's going to allow and kind of push a lot of these companies to onshore and bring manufacturing back to the United States, whether it's pharmaceuticals or whether it's auto parts. It's coming back to the United States in a very big way. We haven't seen that hit. That's going to hit in the next couple of years. The AI spend is valued at like 3 to 5 trillion in the next few years.
Yeah.
That's a huge number.
But
and then the Fed will start easing in a massive way when the new chairman takes place next May. So I look at 2026 and say, as strong as the economy is today, the surprise is actually going to be to the upside. And people aren't prepared for that because all the stim is coming in the next couple of years. It's not that I'm all bulled up on the economy. It's just that I'm reading the facts. And these are the facts on the ground.
There have been arguments, though, which is why I was going to jump in when you talked about AI, that we've gone beyond the facts, that there is an AI bubble brewing. IMF said it this week. The BOE is worried about a bubble, too. The fact that we've pushed so much money into it from all corners, private credit is getting increasingly involved in infrastructure. Is there a real risk that we've gone too far, that there's a promise, but just we push it too far in the beginning stages?
The bubble isn't how many people are talking about the bubble. That's the bubble, and that will pop. And so here's my read on the quote, the bubble, right? So when you had a bubble, dot-com bubble, let's just go back and look at the history books. I don't know what the high was on the NASDAQ, but it fell from like 5,030, 5,040 at the peak. You guys can pull that up. To 1,030, 1,040 at the trough. That was a 77% decline in NASDAQ. When you had the bubble from the real estate bubble and the equity market bubble in Japan in 1989, the index fell from 40,000 to less than 10,000. Again, a 75 to 80% decline. So I don't know where you guys are here at Bloomberg in terms of thinking the stock market's going to pop, the bubble's going to pop for the stock market, and AI is going to lead that, and it's going to lead to some horrendous decline in equities. I'm taking the other side. I'm saying earnings are solid. I'm saying AI is so transformative. Every company in S&P 500 is going to have to use AI. Every service company, the banks, the advertising companies, the accounting companies, every law firm, every manufacturing company. The corporate spend in the S&P 500 and beyond that, public and private companies, every software company that will have to, embedded software company that will have to adapt to AI. And so the spend is huge, it's real, and where Microsoft and Meta and Amazon and Google are taking hundreds of billions of dollars a year collectively in free cash flow and putting that CapEx back into AI to adapt their company, is that a bubble? It's the best companies that are driving that. Now, will there be these neo-clouds, these neophytes, these younger companies that don't make it through the door, the poorly capitalized companies? Absolutely. There may be a bubble in some of those valuations, but it's not going to take the stock market down like you've seen in bubbles, because I don't think we're setting up for that dynamic. This is transformative. When you go and see a doctor, you go to that hospital, every hospital system will use AI. Your radiologist will read your MRI through AI. And so it's all moving in that direction. And I think it's just the early innings, and the spend is real, and it's by real companies.
I just want to point out how close you were. So the high on the NASDAQ on March 10th of 2000 was 5,048.
Okay.
And it dropped to a low on October 9th, 2002 of 1,114.
There you go. And so it's roughly 75 days. I think its number is 77% is the number I have in my mind. How much the stock market collapses.
That's right, 77.9%.
When a bubble actually breaks. Yeah. And you look at NASDAQ or you look at the Japanese Nikkei, you'll see the same type of decline. And those are your bubbles. This is nowhere close. I doubt when AI has a correction, we'll see a 15% decline. And so that's just a correction, and we've seen that before. And so, to me, it's no big deal. I think the earnings growth is real, the economic growth is real, the spending is real, and the transformative way in which it will affect all of us in our daily lives is real.
Bruce, I love that you say, like, I'm not just overly bullish, I'm just looking at the facts. You sound incredibly bullish, and I get it. There's so many factors leading to economic growth and leading to companies that are doing really healthy. Is there anything that you're concerned about that could spoil the party?
Well, there's in AI, we stick with, at Marathon, we stick with funding through the lending market, through the leasing market. Again, if it's a $3 trillion spend in the next 4 years, and it's anywhere from 3 to 5 trillion in the next 5 years is the numbers I'm saying. But $3 trillion spend, I think $1.5 trillion of that will be through equity, and about $1.5 trillion of that through debt. We're not investing in all the debt. We're sticking with the best capitalized companies, the multi-$100 billion plus club that are the incumbents in the space, that are leaders in the space, and we're financing through loans and leases their build out, whether it's data centers or what goes into data centers, the chips, the racks, the wiring, and that's where we're focused at Marathon, financing the best for what is this transformative build out that is real, that's impactful, and you're dealing with the best credits, because at the end of the day, as a lender, we want to only deal with the best credit-worthy partners. Now, in terms of what I'm worried about, I'd steer away from consumer unsecured lending space. And so some of these buy now, pay laters, installment loans, subprime auto loans. The average subprime auto loans, you look at Tricolor or anybody, but an average subprime auto loan has a FICO score of 580, has a rate of 21.3%, but yet loss adjusted, you only get an 8% yield. So what happened to that extra 13%? It's all due to losses, because the loss rate is huge, and the recovery rate after you hire the repo man, go through the auction process of selling off that car, is only 30 to 35 cents on the dollar. And so we steer clear of the over-levered, low FICO consumer, and we lean into hard assets, good companies, whether the company's going through a restructuring like a First Brands, and it's a great company with an over-leveraged balance sheet or a balance sheet liabilities that you didn't know about, or high-quality growth companies that we can provide growth capital, but be secured, senior secured, backed by their best assets. That's what we lean into.
By the way, to get back to First Brands and Tricolor and any situation where the money has fooled the creditor, like a Bill Wang at Archegos. You made a great comment during the commercial that I hadn't really thought about, which is that these things should somehow be on a public blockchain. The VIN numbers, for example, at Tricolor, that would change the whole story, wouldn't it? Change the whole game.
Isn't it crazy idea that you can take a car with a VIN number and pledge it to one bank and take that same car with a VIN number and pledge it to another bank or separate securitizations? That's a crazy concept. If it was on the blockchain and you had irrefutable facts and it was recognizable, it was publicly disclosed, you wouldn't have any of these issues. And so all of these questions of accounting irregularities, and as well as just processes. And so think about a mortgage origination when you have to do a title search. That should be in the blockchain. Why are you spending all that money on title search? You know the prior owner, you're the owner now for the closing. All the mortgage recording and the mortgage recording tax and your interest payments and your principal amortization payments, all on the blockchain. It's all there for your servicer to report to the investor in that loan. Fannie Mae and Freddie Mac should be, when they go public, should be on the blockchain. Every single loan and every private mortgage should be on the blockchain. Every private loan should be on the blockchain. It's what will cure that issue that you just brought up.
A leader in the space, are you pushing for this anywhere? Are you helping lead the charge?
Absolutely. I wouldn't say we're leading the charge. The companies that originate these mortgages and these loans, we want to deal with them if their loans are on the blockchain, so you can see that this doesn't, that example of fraud that you just brought up, or alleged fraud that you just brought up, to make sure that doesn't happen to us. And we've steered clear of those issues, and haven't been caught in those issues. And maybe a little bit of that is through luck, a lot through the diligence that we do. But the luck part won't be part of the equation if you have irrefutable facts and the blockchain recording every loan and every asset.
It could be, hard work and experience, Bruce, from Tulane through DLJ to Marathon. Bruce Richards, pleasure having you on the program. Coming up, the long-awaited IPO revival is poised to slow if the U.S. government shutdown drags on. We'll discuss with Tommy Rueger, global co-head of equity capital markets at UBS. This is Bloomberg. Getting out of high interest, look what's making headlines around the world. Israel and Hamas have agreed to a ceasefire that includes releasing all the remaining hostages in Gaza. It's the first breakthrough in a 2-year war that's ravaged the territory. The U.S. brokered deal will see Israel free nearly 2,000 Palestinian prisoners and begin troop withdrawals within a day. The Israeli Security Cabinet and the full cabinet are meeting this hour to formally approve the agreement. Crowds in both Israel and Gaza celebrated the truce. Norway is on edge ahead of tomorrow's Nobel Peace Prize announcement as President Trump intensifies his campaign to win the award by contacting Norwegian officials and rallying supporters online. His pressure has left Oslo in an awkward spot, especially as it negotiates a U.S. trade deal and guards a $2 trillion wealth fund heavily invested in the U.S. The Nobel Committee says it made its choice before the Israel-Hamas truce, suggesting that Trump's lobbying efforts may be in vain. And the government shutdown is hitting taxpayers and travelers hard. The IRS will furlough 34,000 workers, pausing most of its services. In the skies, air traffic control shortages are delaying flights from Dallas to D.C., while the TSA warns of longer lines. Meanwhile, Transportation Secretary Sean Duffy says air traffic controllers who call in sick during the shutdown will not be paid. This is all putting more pressure on Washington to strike a deal. House Minority Leader Hakeem Jeffries joined Bloomberg TV earlier to talk about the stalemate with the GOP.
They've refused to negotiate at every step of the way throughout this year. They've taken a my way or the highway approach. They've gone it alone. And now we find ourselves dealing with this mess of this Republican healthcare crisis, and time has run out.
With that shutdown now in its second week, the IPO plans of a handful of companies have been left in limbo. An extended shutdown could threaten to hold up companies that have targeted going public before the Thanksgiving holiday and cool the momentum that we've seen in this market, which has recently picked up. Joining us now is Tommy Rueger, Global Co-Head of Equity Capital Markets at UBS. Tommy, great to have you in.
Thanks for having me.
So, okay, if we get this extended into another week, another few weeks, is the impact just IPOs delayed, or does it do some real damage to sentiment in capital markets?
Look, I think as you think about the IPO market, one, it's been wonderful to see a renewed interest, not just from the buyers of the IPO product and paper, but also obviously the sellers. Their confidence level in being able to execute an IPO successfully has gone up dramatically over the last 6 months. What it's done is it's caused many folks who either were working on their IPO ahead of Liberation Day, which really was the volatility element that caused folks to slow down, to pick back up their pencils. And for many, on the strength of strong IPO outcomes, to think about accelerating their IPO plans. With the government shutdown about a week into effect, clearly, it's impacted those that were ready to move forward and launch in a relatively short timetable. It hasn't slowed down folks who are thinking about still trying to get public for the balance of the year. The expectation is hopefully the government will reopen. The SEC will move these S1 and S11 filings through their ultimate approval process, and sellers can get to the market before the end of the year. What we're obviously monitoring very closely is sentiment over this time period. A lot of the IPO interest is driven with the macro backdrop and the market backdrop. And a lot can happen in a short period of time. So that is what we're monitoring.
I mean, the day, it feels like the world changes day to day. But one of the things we're sitting with, regardless of what happens, is this huge inventory of private capital owned companies. If private equity may be over-investing in 21 and 22. As that starts to mature and as they feel the pressure, is the release valve these public markets, or is it something different this time around?
The good news is if you look across capital markets and you look across exit opportunities, there has been a dramatic pickup across all the capital markets and including M&A. And so what we do have now is we have an opportunity for sellers, potentially private equity firms, if it's an asset that they own, to look at multiple and various options and alternatives to get liquidity and return liquidity back to their LPs and shareholders. Well, and so the deal environment, broadly defined, has been improving, and our hope and expectation is that continues and provides them optionality as they think about how ultimately to best monetize those assets.
We just heard from Bruce Richards some pretty bullish arguments for the U.S. economy. Next year, we continue to see new record highs for the stock market this year, but also amazing runs in 23 and 24.
Yep.
Do you see a time where we get back to the 2021 record for IPOs? Because that was massive.
That was massive.
Yeah.
I'm not sure that I can confidently say we'll get back to that level, but I do feel that given the amount of supply that has been building over a couple of year period as the IPO markets and exits broadly defined have been slower, along with what clearly seems to be a very constructive and conducive backdrop when you talk about markets, when you talk about the economy, when you talk about the Fed potentially
and tech mechanisms,
to ease.
Tokenization, I mean.
Thematic growth drivers that's continuing to see an abundant amount of capital behind it. This feels both durable and sustainable. And should get us back to, if not the 10-year averages, north of those, and to a robust new issue environment, which is accretive for everyone.
There does feel, though, to be this real conversation happening now of do companies actually want to be public? Private equity, they are having more discussions of continuation vehicles, evergreen funds. President Trump realizes how onerous it is and has been talking about letting companies report just twice a year. There have been a lot of take privates. Tommy, just going forward, do things look forever changed because of the availability just to stay private for longer, or more private capital willing to take these companies private?
The private markets remain robust. There's a lot of reasons for a company to go public. whether it is liquidity for shareholders, liquidity for employees, liquidity for the company to continue to support its growth over time. All of those remain relevant today. And so it's just about timing, really, the state of the company, its capital needs broadly across constituents, and whether the public markets is a viable and best path to continue to take. Our expectation is that as the markets continue to hopefully strengthen, improve, and do so in a durable fashion, and that sellers and companies can rely on that capital ultimately as they think about those different constituencies. We think that many companies who have been private, for quite a long time will ultimately move to the public markets, and that will drive another strong IPO market.
All right, Tommy, really fantastic intel. Great to get you on the program. Hope we can get you back soon. Tommy Rueger there of UBS. Still ahead, Fermi just went public last week. We'll be joined by the company's CEO in just a few minutes as they attempt to build out 11 gigawatts of capacity in Texas.
Some of the single stocks moving at this hour: rare earth and critical mineral stocks moving after China unveiled new restrictions on exports ahead of a meeting between Presidents Trump and Xi. Meanwhile, Novo Nordisk will buy Akero Therapeutics for as much as $5.2 billion to expand its portfolio in a type of liver disease linked to obesity. This is Bloomberg.
Toby Neugebauer is redefining the term wildcatter in Texas. The son of a former congressman, Neugebauer kicked off his career at Kidder Peabody before branching out on his own in private equity. He is now pioneering the development of a next-generation private electric grid to support an 11 gigawatt, 6,000-acre AI data center with the former governor of Texas and U.S. Energy Secretary Rick Perry. Neugebauer joins us now after the IPO of his new company, Fermi America. And Toby, this is an audacious undertaking. I mean, 11 gigawatts is far more energy than the entire city of New York uses. How confident are you going to get this done?
Well, you're right. It's almost double the amount of electricity that New York consumes and produces. And the reason we're able to do this is we're in one of the most blessed natural resources part of America. So we have an unlimited amount of natural gas. We have the gas pipeline infrastructure, and that's what gives us the confidence. We have what is necessary to cool it. We have the fiber to export the AI compute from it. So that's what makes it possible to make such a bold statement about 11 gigawatts. And then we have a team that has built over 25 gigawatts of power all over the world in their career. So it's the combination of the infrastructure, the natural resources, and the people to execute to make it happen.
And I know you're hoping to draw some data center and hyperscaler tenants into this, Toby. How have those conversations been going? Who are you talking to? Are you close to signing anybody on?
Yes, I think as the market knows, we have a letter of intent with one of the biggest companies in the world. We've been with that company all week, getting ready. In fact, we're basically constructing for them now. We just have to catch up our project financing, et cetera, because we've been so busy. And that is publicly known to be scheduled for closing in December. So we are assuming success with our current customers, and then we're in conversations and changing papers with 4 of the other biggest companies on the planet. There's no shortage of demand for the electrons that Fermi America can produce out here at this site.
So how much of this power is going to be natural gas? How much of this, as Texas is known for, obviously, how much is going to be nuclear? The U.S. has been slow to bring more nuclear online, but I know you're in a good position for that as well. And how much is going to be solar? I mean, what's the breakdown look like?
Well, again, we're heavily focused on solar. How you should think about how we look at 3 units of gas or nuclear to every unit of solar. So we're talking about a very big solar operation. What's great about our site is we can do 11 gigawatts of power irrespective of nuclear. But as I believe is to be a real superpower, America has to have nuclear-powered submarines, nuclear-powered aircraft carriers, and a real superpower has nuclear-powered artificial intelligence. The Chinese are building 22 reactors right now. They're not building those reactors to lower air conditioning costs in China. They're building those nuclear reactors to power artificial intelligence. And we think that this administration gets that. And I expect at least 6 gigawatts of nuclear power. As you know, our site is already on America's most important nuclear site.
And Toby, it speaks to the national security concerns. And Fermi and you yourself are very tied to public service. Your dad was a former congressman for Texas's 19th district. Your co-founder is the former U.S. Secretary of Energy, Rick Perry. Just given those credentials that are being brought into Fermi, what do you see as the mix between private and public investment that's necessary in our energy capabilities to fuel AI?
Yeah, what we don't want to do is to create incentives to have bad spending like we've had in nuclear in the past. We want an incentive structure that rewards success, and that means bringing nuclear online, on budget, on time, on budget in the United States. What I do see us in terms of our relationship with the government is providing the power that they need for their own artificial intelligence needs. So we're not looking for a handout. We're looking for delivering a high-quality, nuclear-powered artificial intelligence product for the United States of America.
I wonder about guardrails here. On Tuesday, we're going to talk with Paul Tudor Jones, and he has argued about the need for some kind of regulation, some kind of checks and balances on AI, or he's worried what it'll do to humanity. On the other hand, widely reported that Peter Thiel recently said regulation will bring on the Antichrist. What do you think, Toby, about what do you think, Toby, about regulating this? Because we are in essentially an AI arms race, right? We want to have better AI technology than the Chinese, and I mean every country in the world wants to be at the forefront of that. So how do you deal with regulation?
Well, I think first and foremost, what we've got to do is we have to unleash electrons, because it won't even matter what the regulatory regime is. If we don't rapidly increase the amount of production of electrons in this country, we are going to lose no matter what, whether you regulate or don't regulate. So that's our number one focus. And what we did at Fermi America is creating a private utility. We don't take away from the consumer, and we can regulate ourselves because our private utility is designed for our customers. As it relates to whether I agree with Paul and I agree with Peter, and it's going to be a really big decision. What we got to do, though, is be in the game. And I'm very concerned with how far behind on the electron production we are with the Chinese. I don't think that's getting the attention it really deserves.
All right, Toby, this has been really fascinating, and a very valid point is this concern about our consumers going to face higher bills with the energy need. Toby Neugebauer of Fermi, thank you so much for joining us this morning. Matt, let's get a quick check on markets because we're over an hour into your trading day, and we continue to move more negative. The S&P down by 0.4%. The NASDAQ is leading that. Some of the big tech players down this morning, but that follows off the back of a really large rally, and a rally that's been concentrated in the chip makers, with AMD posting gains of 11% yesterday, taking its total to near 40% of this week. Yields are moving higher, so maybe it is just some exhaustion.
Yeah, a little bit of, we weren't allowed to say this when I worked on the stocks team. A little bit of profit taking, maybe. After we hit record after record after record, you got to figure somebody wants to take a little bit of profit here, maybe diversify, maybe put it into something else. And I don't think it should be shocking after we hit 67.50 and change that we come down 1/3%.
A few more sellers than buyers, if you will.
Let's get a look at some of the single stocks moving at this hour. Airlines are soaring Actually, no pun intended, but it works. After Delta's outlook suggests robust demand for 2026, Delta itself up more than 5%, AAL up just 0.4, and United up 2 2/3.
Interesting that Americans no longer playing along, though. Elsewhere, Pepsi reported its strongest growth for its beverage unit in 2 years. It does face pressure from Elliott Management, which took a $4 billion stake last month. Those shares up 2%, Matt.
And shares in Ferrari are falling the most since the IPO in 2016 after a cautious forecast and plans to scale back its EV lineup. That should actually be good for the shares because who wants to buy a Ferrari EV? But you can see that those shares just getting hit so hard. They've been up 170% in the last 5 years, so they've been on quite a tear. Keeping up with Tesla even. But
right, you pointed out they've done better than every other car maker, right?
Yeah, except for Tesla.
Except for Tesla.
Yeah, they have done better than all of them by a long shot. They obviously have a luxury product, so it's thought of differently than say GM or Ford, obviously, but also BMW, Porsche, Mercedes. We're going to have the CEO of Ferrari.
Really looking forward to
next
that.
week. Yes,
when
he
is
used to
that?
run ST Microelectronics.
So the head of a car company was a chip company head.
Yes, and
Sign
now
of the
I mean
times.
they use thousands of chips and on every corner of suspension for those cars.
Fair enough. All right, let's head to LA now, Matt, where our Screen Time conference is underway. And Jimmy Kimmel is among the star-studded lineup. He sat down for a wide-ranging conversation with Bloomberg's Lucas Shaw. The interview was his first since returning to air following the comments he made about the assassination of Charlie Kirk.
I think what has happened over the last 3 weeks, I think was very unfair to my bosses at Disney. I don't think anyone should ever be put in a position like this. It is insane. And I hope that we drew a really, really bold red line as Americans about what we will and will not accept. I mean, I really hope that that's what comes out of all of this.
Netflix co-CEO Greg Peters also sat down with Lucas Shaw, telling him the streaming service is making its video games available for play on TVs for the first time.
We are now announcing, we're going to announce here actually, that we're going to have these social party games, a pack of social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game, we've got Tetris, we've got like a Mafia style whodunit.
Joining us from the Screen Time conference in LA is Bloomberg Tech co-host Caroline Hyde. Caroline, from political pressure to technological innovations, it feels like a moment of change for the wider entertainment industry. What have been some of your takeaways so far from the conference?
Well, I think the clear, the candid, the at times comedic conversation that was had with Jimmy Kimmel, so well navigated by Lucas Shaw, was one that everyone sat up, leaned in, and wanted to take notice of. And this is someone who has very clearly set his own red line. He made very clear he doesn't want the FCC chair ever coming on his show, but he does indeed extend an invite to President Trump, should that ever be the case. He talked about really the disconnect between some of the channel owners, of course, the likes of Sinclair, who turned to him after his initial statements on the killing of Charlie Kirk and said, we want an apology, we want you to donate money. And he said, I'm absolutely not going to do that. And of course, his show was taken off the air. He talked very warmly of Dana Walden, the head of entertainment over at Disney, talking about how she really helped him navigate this moment and took away some of his anger and his fire and able to relate to the American public unscripted on the time that he came back. To that 23rd date when, of course, he got record viewership. So that was a really clear, candid conversation where he really said, look, I was maliciously mischaracterized and taken out of context by the right. So that was a political conversation. But then you turn to Greg Peters, who's much more about new innovations, as you say, gaming, coming to Netflix. But I thought what was really interesting was also the M&A context. That is everything that's happening in the world of content right now, right? And he's saying, look, when asked about Warner Brothers Discovery, would he ever be enticed into any sort of M&A deal? He's basically said, look, M&A doesn't work in my industry. You have to be very skeptical of thinking that Netflix isn't going to be growing organically and that ever really would be going out and making big purchases inorganically. But what's so interesting is, of course, the co-CEOs of Warner Brothers Discovery are coming to this event today, so they're going to be pushed on what their take is in the whole narrative of what's happening in their industry. We're going to have some incredible speakers. There are the politics. There was the mayor of Los Angeles who was on stage yesterday as well. Another really incredible conversation. We're going to have the head of NPR here sitting down with us and how she's helping navigate what is ultimately a cutting off of financing for what has been a key contributor to the United States and educating them about the news.
Caroline, great conversations to come. We're looking forward to your coverage during Bloomberg Tech and beyond. That's Caroline Hyde in LA. And stay tuned for those conversations from the Bloomberg Screen Time Conference. It includes Paramount Skydance CEO David Ellison, a conversation you don't want to miss.
Coming up, Carlyle releasing proxy data to help fill the gap left by the government shutdown. Jason Thomas joins us, Carlyle's head of global research and investment strategy next. This is Bloomberg Open Interest.
With the government shutdown delaying key economic data, Carlyle is stepping in. The private equity and capital giant releasing its own proprietary data based on its expansive portfolio. It showed weak U.S. employment, but corporate spending continues to power U.S. growth. Pleased to say Jason Thomas, Carlyle head of global research and investment strategy, who put this together, joins us now from Washington, D.C. Jason, great to see you. And this is the holy grail, right? Even whether we have the data or not, what alternative data can you use to get a handle on this economy? So what did you look at to compile this picture of America?
So we have 277 portfolio companies currently that employ about 730,000 people. So each month, and we've been doing this for about 15 years, we get a lot of data from those companies. Business volumes, revenues, orders, backlogs, prices paid, prices received. Very often it's by a number of different business lines from the company. So again, a large number of time series from each company. So we have a very large matrix that we then weight. So we have an algorithm that essentially weights those data to replicate time series of interest like GDP or payroll employment, industrial production, other series like that. And then each month we get the data that come in, again, after going through this weighting algorithm, and we measure where it is in relation to the prior trend and measure how discrepant that is relative to our expectations. And if it's statistically significant, we move the estimate up or down proportionally. And then, of course, we look at the evolution of official statistics. Very often they're significantly revised. I think it's important that everyone recognize that these official statistics are not handed down on stone tablets. They're just estimates too. They're using the same sort of sampling techniques. And then, over a period of, say, 6 months, we can re-weight our data if there's any signs that it's not quite tracking the official statistics as well as it had in the past.
Well, Jason, do you, I assume you backtest your data against the Bureau of Labor and Statistics, so I'm wondering how well does it track? Or do you believe that maybe you're getting a better picture of the U.S. labor market than the BLS?
Well, I think that first of all, when you think about the weighting algorithm, essentially we have enough data that we can perfectly replicate over the prior 5 years. So at a backward-looking basis, the sample is very much selected so that it can perfectly capture it. And then on a go-forward basis, the correlations over the next 3 to 6 months range between 60 to 90%. So again, pretty good on a forward-looking basis. I think the BLS has had a tough year, of course, when you think about the scale of the revisions. They cover what they think is about 38% of payroll employment in the United States. And I think it's always hard when you think about company births and deaths. Of course, there's questions about the response rate and who is responding. We saw that during the pandemic. And then, of course, they have an entirely separate series that is the unemployment survey. That is a very small percentage of the population. Of course, it changes every month, but that's another area where, again, these are estimates. This is there's other ways to go about collecting data. So to say it's better, no one has the sample or the breadth of the federal government when it comes to these things. But in terms of what's important for investors, yes, I think there are better real-time indicators. And I think the alternative data sources are something that a lot of people are really becoming much more attuned to.
Well, for what it showed you specifically, Jason, your estimates are for this most recent jobs data that we didn't get would be that 17,000 jobs were created. You can look at that number in face value and say that is painful and significantly below numbers before. How do you interpret 17,000, especially as we ask questions of what the real break-even rate of jobs growth is, considering how much immigration is changing?
That's right. I really think that that's the critical question here as one evaluates this. If you just look at the raw numbers, you see an economy where payroll employment growth was averaging about 200,000 at the start of the year, and that falls down, again, in our estimates, below 20,000. You would say, boy, this is an economy that is on the verge of recession or perhaps has already succumbed to recession. But I don't think that's the correct interpretation because it doesn't actually jibe with any of the other data that we're seeing. In fact, we saw GDP growth in the quarter of about 2.7%, a rebound in consumption, particularly travel, tourism, live events, those experiences. And then, of course, business spending growing about 4.8% annualized rate, according to our data. Much of that, again, the AI, this concentrated CapEx boom. So I do think that there's some decline in labor demand. We did see some evidence that when we, again, weight the sample for the broader U.S. corporate sector, that margins did contract relative to year-ago levels. I think there's less hiring, perhaps because of tariffs, related uncertainty. But I do think most of this is explained on the supply side, which is to say, moving from a very large volume of immigration to this year what could be something close to net zero immigration. The U.S. Population, domestic population, is only expected to grow about 14 basis points this year. Wow. If you apply that to 160 million payroll employment, that implies full employment monthly job growth of only about 18 or 19,000.
It's pretty fascinating stuff. Really cool data, Jason. Love to have you back and talk about it as this story evolves. Jason Thomas there of Carlyle. This is Bloomberg Open Interest. It literally is one for sure. Let's get a check on what's going on in the markets right now. We're looking at losses across all of the major indexes here. The S&P 500 down 0.3%, still at 67.33, darn close to the record high that we hit yesterday. Was it 67.58? I believe it was right around there somewhere. The NASDAQ coming off about 0.4% as well, and the 10-year yield rising, but only to 4.13, 4.14. So maybe a little bit of profit taking here. It doesn't look like concerns that an AI bubble is about to burst.
Right. I mean, plenty of people have voiced it. Both the IMF and the BOE in recent days have talked about it being a bubble. I wonder how much of this is also led by gold hitting a record high, by silver hitting a record high, and the two of those things not driving, to say people are trying to take out extreme hedges and are concerned about things like U.S. sovereign debt, are concerned about an ongoing government shutdown, but it's not being reflected in equity market. Maybe some of those nerves are finally coming through. If they are, I mean, it's like down 1/3%.
Well, and we get fantastic news kind of on the consumer today, right? They're still apparently willing to pay more for Pepsi products. Yes. They're still apparently buying seats on Delta Airlines. So even though they may order fewer Ferraris over the next five years.
They're drinking soda that will rot their teeth, and not rot their teeth, because Poppies doesn't have sugar.
So good for you. Coming up tomorrow, Joanne Shu of the University of Michigan on consumer sentiment, KKR's co-head of credit, Chris Sheldon, and we'll talk gold and silver with the CEO of Wheaton Precious Metals.